everyone, it's Annie, your local real estate agent in Central Massachusetts, and I'm here with our monthly market report. I'm going to start here with a look at a graphic from ShowingTime, and ShowingTime is the real estate industry's leading showing management and marketing stats technology provider. If you look at this graph going all the way back to January 2020, you see the dip down during the lockdown of the pandemic in red there. And coming back up, we've been cramming a bunch of real estate transactions into the first part of this year, and now we're starting to level off. And you can see that with that yellow line here, we're slightly below where we were this time last year, September being the most recent data that we have. So why is this important? A lot of people are wondering right now, is the market starting to slow down? Is the market leveling off? What's happening? And this is happening relative to 2020, but I always want to give you some perspective. So here we have ShowingTime data that goes all the way back to 2017. 2017, 2018, 2019, probably the most normal markets that we can look at. And then the pandemic in 2020, which was of course not a normal market. So we have come down a bit in 2021 in relation to 2020, but again, 2020 was not a normal market. So you could say we're really normalizing here. We're still well ahead of where we were coming into the pandemic. So there's no question that every market across the country could use more inventory and more buyers. I want to give you a couple of articles here that are out right now that can be pretty misleading with their titles. This first one from Realtor.com says foreclosures are shooting up. Is this a repeat of early 2000s housing crisis? And this is a headline that I think we can expect a lot more of. We can see here foreclosures are up 49%. Factually, that is correct, but it's nowhere near where we were in 2019, which was the more normal market. We should expect foreclosures to be up as the moratoriums have been lifted, but nowhere near the volume of what we saw pre-pandemic. And certainly as we go into next year, there will be those that are affected by the pandemic, moratoriums being lifted. But with this sort of headline, it's easy to get scared and concerned. And it's important to know that this is in relation to 2020, which was an abnormal year. CNBC came out and said this: mortgage originations will drop 33% in 2022 as interest rates rise, according to the industry forecast. When you see headlines like these, you really want to take the time to read the article, and I'll bring up part of that article real quick. What they actually say is refinance originations will drop 62% in 2022, and that makes sense. In a rising interest rate environment, we'll see less refinances. However, they go on to say mortgage originations for the purpose of buying a home are forecasted to rise 9% to a record $1.73 trillion next year. So the headline doesn't really do anything to inform you. You have to go into the article for the real information. I think the biggest question that people are asking today is what's ahead for the 2022 housing market? What I'm going to bring to you today is the data, the expert insights on what's really happening in the market, because as you know, there's a lot of confusion. There are headlines that terrify, not clarify, and people are seeing rising prices and rising rates. What I want to share is the data that shows exactly what's happening and helps you really separate out the noise, because it's the noise and confusion that's going to put people on the sidelines and have them wait to buy or sell their property. So I think it really starts with the conversation on mortgage rates. Let's take a look at this quote from Doug Duncan at Fannie Mae. He says, right now, we forecast mortgage rates to average 3.3% in 2022, which, though slightly higher than 2020 and 2021, by historical standards, remains extremely low and supportive of mortgage demand and affordability. What does that mean? We're seeing a projection for increasing mortgage rates. As mortgage rates rise, it will cost more to purchase a home. And that's exactly what we've been talking about with the affordability. Mortgage rates, prices, and wages are the three levers for affordability. So if the mortgage rates are projected to rise, it will cost more. But the great context here is the piece about the historical standards. If mortgage rates are ticking up a little bit, it will cost more, but they will remain historically low based on projections. And that will support affordability. So that's great news for buyers, but it's important for buyers to buy before the mortgage rates rise even higher. Let's take a look at what the mortgage rate data looks like. This is data from Freddie Mac and its average mortgage rates going all the way back to 2018. And what you can see here is that mortgage rates were just under 5% in 2018, and they've dropped pretty significantly since then. We hit that kind of all-time record low at the very end of last year, early this year, and they've started to tick up again. You can see Freddie Mac is saying mortgage rates are projected to rise to roughly 3.6% by this time next year. So if buyers are thinking of waiting a year or 2 years, maybe even 3, it will be more expensive to buy. If buyers are ready to buy now, buying now before the mortgage rates rise is critical to that affordability lens. Mortgage rates are not the only thing on the rise for next year. Home prices are forecast to appreciate as well. What you're looking at here is the home price appreciation or home price forecast for 2022, and they're averaging out to about 5.1% appreciation next year. Over the last year, home prices have appreciated at a record-breaking level, 18, 19, almost 20% appreciation. Next year, the forecast is showing continued appreciation, but at a slower or more moderate rate. Inventory is still a big challenge as we look at the supply and demand conversation that we've all been having over and over again. Supply is low, demand is high. That's going to naturally make prices rise. We'll still have an inventory challenge next year, but likely softening because builders are coming back to the market, building more homes. We may anticipate more sellers to feel less pressure coming out of the pandemic, and they may be more interested in selling their homes. There's just a variety of factors that as more homes come to the market, home price appreciation will ease a bit, but continue to rise because of the inventory situation. It won't be fixed overnight. As we think about mortgage rates rising, pricing rising, what does that mean for home sales next year? So in 2020, there were 6.5 million homes sold, and that was record breaking. Home sales are forecast to increase this year and perform well again in 2022. We're anticipating a strong spring. What does this mean for buyers? Of course, buy before prices and mortgage rates rise to maintain that affordability. What does it mean for sellers? It means home equity will continue rising, and that's a huge factor. If you're thinking about making that move, doing that before will help sellers leverage that equity while they can still lock in the low interest rates and take advantage of the current home price appreciation. I think as we go into next year with prices rising, interest rates rising, home buying is going to cost more, we need to talk about the non-financial benefits of home ownership. I think we're seeing a different trend than what we saw previously. And Don Layton from Harvard University says this: home ownership is regarded as causing an improvement in the quality of life of a typical family. It is the most common method for such a family to build wealth. That can be used for retirement, other needs, including helping the next generation. Such wealth creation, therefore, provides a major social as well as economic benefit. We've talked a lot about the economic benefits with rising prices, equity rising, but let's talk about the non-financial benefits and what that looks like over the last year and a half across the country. So in 2021, 64% of American homeowners say living through a pandemic has made their home more important to them than ever. I'm sure all of us can probably say this on some level. This has been true. 83% of homeowners say their home has kept them safe during the pandemic, and 91% of homeowners say they feel secure or stable or successful owning a home. We can say confidently that homeownership and the non-financial benefits of homeownership are growing. The home has just become much more important. Inside of that study, homeowners that feel emotionally attached to their home pre-pandemic was about 58%. Now it's 70%. A rise in the number of people that say, I feel more attached to my home after going through a pandemic, and that makes sense. Mark Fleming from First American says, buying a home is not just a financial decision, it's also a lifestyle decision. As we wrap up this year and go into the next year, many people are thinking home has become more important to me and my needs have changed. You may be thinking of leveraging that equity, selling your home, buying a home, and just realizing there's a different decision that you need to make about home. If that's the case for you, I'm happy to discuss further what might be the best decision for you and your family. I hope all this information finds you well. I would love to share my buyer and seller guides with you. Fall guides are out now and winter guides will be out next month. Feel free to email me at AnnieOakmanRealty@gmail.com for the guides, and be sure to check out our video next month. Don't forget to follow me on social media at flipping_millennials. I will see you guys next time.